things that we have created, and I mean that, these things that we as an economy have created, that the Chinese trade war, the Brexit situation, the government shutdown, that's all humans doing, causing these issues. Slowing growth is a real concern, but that's not going to play out in a day. These things are playing out every single day, and every day you have more positive momentum coming back into the market because these obstacles are being pushed aside to a certain extent, and understandably so. So in terms of this, how should a trader go about their routines? Should they change anything as these things change, as these things go further into the mind? My point is, at what point do you get aggressive?
Get aggressive with the bullishness?
Yeah.
What's to say I'm not already being aggressive?
Well, I know, but we are slightly bullish. Right?
Yeah, no, I've been very, I'm always cautiously bullish. I personally don't like to get overly aggressive.
Mm-hmm. Wait, as a trader, you don't go all in on one direction?
Well,
No.
I have.
That just sounds like you know what you're doing.
I have in the past, Cody, and I learned real quick how to lose money. When you go all in,
the market can't teach you that.
Yeah, the market can take you out behind the woodshed and give you a severe beating, and you'll learn something from that. You won't have any money left over, but you'll learn something from it. So I'm always cautious on that, and position sizing and stop losses, and I try to keep my portfolio balanced as best as I can. Just because I know that the market is fickle, and even though all signs point to yes, as the Magic 8 Ball says, I still have risk management in place and position sizing. When I get more conservative and nervous, I pull back on position size, but I'll still trade this. I'll still trade the trend. And so probably what I do if I'm getting more aggressive is I just end up with more positions.
Yeah, and one way that we kind of determine how aggressive versus defensive or conservative or bullish versus bearish, however you want to categorize it, but one of the ways we kind of do that is a concept called delta weighting, right? Correct? Delta weighting is basically how you match your delta versus your portfolio. Can you talk about delta weighting for a second?
Yeah, you bet. Again, delta is your sensitivity to your direction. It's directly correlated to your position size in stocks. Like if you have 100 shares of stock, that would be a 100 delta. If you owned it positive, you'd be bullish. If you'd sold it short, you'd be bearish. Your options positions, when you buy and sell options, each has a positive or a negative delta according to whether you buy or sell it. And you basically build your portfolio using the strategies that match your bias. You build your delta to match your bias. And then, there's trading strategies that involve delta neutral. When the market gets bearish, you want your delta to match the trend. So I usually have my delta matching the trend. And as I become more bullish, my delta increases. And as I want to lock in gains, I start to decrease that and turn it into a more neutralized portfolio. I do a lot of adjustments, Matt. So when I start out with even a strong directional trade, it's not long before I've shifted that and changed the trade to something more delta neutral. Start trying to take advantage of one constant in the market is time decay. So you want to basically know how and when to open up your portfolio delta, because that's when you get really good capital gains. Otherwise, I think your goal is to focus on cash flow. And I think that's a big challenge for traders, is knowing when to open up the delta, when to go for the gold on that. And, it's kind of a Pareto distribution. You'll end up with 20% of your trades will end up giving you 80% of your gains. And it's just knowing when to again, step on the gas.
Well, that's kind of what this whole conversation is about, is when to step on that gas, when to adjust that delta into more of a positive delta so that you're more directional, right? And whenever you go more directional, you're going to give up some of your positive theta because you're buying options or something along those lines. So a slightly, in my opinion, a slightly bullish delta coupled with a slightly positive theta is the best way to go about this market right now.
I mean, let me give you an example. I think I can just show you an example here of what that would look like. This is actually a pretty bullish delta right now. It's quite bullish on that delta column.
Yeah, can we delta weight that real quick, no? Beta weight it.
Beta weight it. So if I beta weight it against the SPY, for example, Okay. It's bullish, but
Yeah.
it's a little over manageable. I usually personally weight it against the futures. And so I'd need 2 contracts on the futures to hedge that. That means I probably want to pull it back because I don't like to hedge with 2 contracts if I can do it with 1. So I need to look to that. And I've got a theta problem, Matt. I've got almost all my theta positions. I'm not in an account. I'm not in the right account. This is my other account. So it just took me a minute to figure out, hey, why is my theta so low? It's like, oh, this is my other account. This is just my Delta account for master trader classes. But
Gotcha.
yeah, so that makes me want to log out. But that's the idea is you want to manage that, that position, and you need to know your risk. If the market were to shift suddenly, this really gives you an idea of how much insurance you need to get.
Hey, switch back to the SPY here, because I use the ES as well, but for most people they use the SPY.
You bet.
So switch back to the SPY, and I'll kind of talk about that delta, what that delta represents. Okay, so that delta it's 712, right?
It's 712, which would take it's going to take a ton of cash to hedge that.
Oh, it'd take a ton of cash to hedge that, but what does that 712 represent? Because a 712 delta represents different for a $10,000 account than it does, say, a $100,000 account versus, say, $1 million account. Because if you have $1 million portfolio, that's not a bullish delta. If you have a $10,000 account, that delta is a ridiculously bullish delta.
Yeah. So if you go with the start out with what the beta is. Beta is just a fancy word for how much stock A moves compared to the index. If you got stock A and stock B or stock C, how much do they move? If the S&P moves $1 and stock A moves $2, that one needs more insurance. If stock B moves, 50 cents, that one needs less insurance. And so it's measuring your stocks against the S&P. And ultimately what that number means is if the S&P rises 1 point, on average, your portfolio is going to make $712. If it falls 1 point, you're going to lose $712. And so if you could imagine if the market took a 50-point drop suddenly and you were leveraged at 712 or so, that's going to hurt. That's going to cost you some money. And it's really just your sensitivity. It's your sensitivity to the market movements and, bullishness here. And it's definitely a bullish portfolio. And to ensure that, you'd have to go buy put options. And that would take, I don't know, 15 or so put options with a delta of 50 or so. You
would have to have 15 at the money put options to hedge a 700 delta.
Yep, thereabouts. So
and that's not a small position.
No, and if you want to go look at that, and you kind of go look at the SPY, and you look at if you wanted to buy that insurance, say through May, and you added up the cost of that. So let's go out to buying some May insurance policies here, and you're going right at the money. You're talking about,
and that's if you want to hedge 100%, right?
Yeah, $786 or so, $787 times 15. So that adds up quick. You'd have to have the capital and cash. Yeah,
it's about $12,000 position. But again, the whole concept of delta weighting is basically you want to match your delta with your market bias, right? You always want to move in the direction of what you believe the market is. And so if you are slightly bullish in the marketplace, you want to carry a slightly bullish delta. Now, obviously, you need a little bit of understanding about how to weight your delta against your portfolio and understand that, for example, I know for 100%, if you have a $100,000 account and you're carrying a 700 delta, that is a bullish positive 2 delta. That's what that represents. If you have a $200,000 account, that would be honestly, that'd be close to a slightly bullish or neutral delta based on that account size. So obviously we might want to do some breakdowns further on, but I just want to talk about that delta weighting for a second, because that is such a good tool to ensure that your portfolio truly is built in the direction that you think the market is going. And so what we do as traders, guys, is as the market does break out, we're looking at that delta and we're saying, okay, I need to add more positive delta to my portfolio as the market is gaining steam. And if the market starts slowing down, I need to start locking in a little bit of that positive delta, so that I can, reduce my delta. It's not even really about locking in gains, although that's exactly what happens. It's more about just reducing your exposure to the overall marketplace. And there are times when the market's very bullish, but I'm carrying a neutral delta. For example, if the market's overextended and a lot of our stocks that we're trading are overextended, in a bullish environment, you could literally very easily still carry a a neutral to a slightly bearish delta, because you're locking in your gains on your positive delta transactions, waiting for them to come back down so that you can reset and hit them again, right? You
Yeah.
always match your delta with where you think that market is going.